Want to grow your savings without chasing every rumor on the internet? This video breaks down beginner investing in the S&P 500 in a straightforward, practical way. We'll skip the hype and focus on a plan you can actually follow. If you stick to it, you'll build wealth over time without stressing about day-to-day market moves. First, what is the S&P 500? It's a collection of 500 large U.S. companies. It's broad, diversified, and it tends to rise over many years. You don't need to pick a winner each year to win in the long run. For a beginner, that mix of big firms does most of the heavy lifting. You're not betting on a single stock, you're owning a slice of a big economy. Before we dive in, lay a solid foundation. Make sure you have an emergency fund and you're not carrying high-interest debt. This isn't glamorous, but it keeps you from selling investments to cover a surprise bill. If you're juggling debt, focus on paying it down first. Investing makes more sense once you have stability and a little breathing room in your budget. Next, set a simple goal and a time horizon. Are you saving for retirement, a home, or just general wealth for the future? Knowing when you'll need the money changes how you invest. Ask yourself how long you plan to invest. A longer horizon reduces risk and gives more room for compounding. The idea is to let time smooth out the ups and downs. With that in mind, choose how you'll own the S&P 500. You can directly buy individual stocks that make up the index, but that's expensive and complex for a beginner. A low-cost index fund or an ETF that tracks the S&P 500 is the practical, straightforward route. The practical choice is a low-cost index fund or ETF that tracks the S&P 500. You'll want to keep fees as low as possible because fees quietly eat away returns over many years. Now, set up automatic monthly contributions. Treat investing like paying a bill you actually want to pay because it grows your future. If you have a fixed amount, say a certain weekly or monthly budget, you can start with a single fund. Then you can add more later as you feel comfortable. This is the core habit that makes investing easy. Automating removes the friction of deciding when to invest. Dollar cost averaging means you buy more shares when prices are lower and fewer when they are higher. It takes timing out of the picture and reduces the urge to chase big dips or rallies. Keep it simple. Contribute a fixed amount each month. Even small amounts add up over time and become meaningful through the power of compounding. Decide how to allocate. As a beginner, start with one fund that tracks the S&P 500. You can add a bond or international fund later if your risk tolerance and goals change. If you're younger, you might stay almost fully invested in the S&P 500. If you're closer to needing the money, consider a small shift toward bonds to dampen volatility. Your personal situation should guide you more than general rules. Rebalancing is the process of bringing your portfolio back to your target mix. If the S&P 500 lifts your whole portfolio too much, you'll want to restore balance with a small bond position or a different fund. Most people rebalance once a year. Some use automatic rebalancing options offered by many brokers. Either way, a light touch works better than letting emotion drive every decision. Taxable accounts add another layer to think about. If you're investing in a taxable account, you'll want to focus on long-term holding. Avoid frequent trading, which can trigger taxes and fees. Another practical tip: set up a simple tracking system. A monthly check-in helps you stay on track without turning investing into a calendar full of stress. Note your contributions, your fund's performance, and any changes you want to make. Common mistakes to avoid include trying to outsmart the market, chasing hot stock tips, and paying high fees. Many beginners also underestimate how emotions can affect decisions during drops. Keep your plan visible and simple. Don't overcomplicate your setup with too many funds. A single S&P 500 track can work well for a long time and only add complexity when you're ready to diversify. Fees matter more than you think. A fund with a 0.04% expense ratio is much better than one charging 0.50% or more, especially if you're starting with modest amounts. Lower costs compound into real gains over decades. Keep expectations realistic. The S&P 500 grows over years, not days. You're aiming for steady progress and fewer big surprises, not overnight wealth. A good daily habit is to review your goals, not the daily price moves. If your goal is retirement in 30 years, a monthly review of your plan is enough to stay on track. Here's a simple, concrete example. Suppose you start with $300 a month into a fund that tracks the S&P 500. If the fund earns about 7% per year on average, your balance grows steadily over time. In 10 years, $300 a month at 7% could turn into roughly a solid nest egg, assuming you don't withdraw early. In 20 or 30 years, the effect of compounding becomes even more powerful, turning small monthly habits into meaningful wealth. If you add an employer match in a retirement plan, that's like getting free money. You should take full advantage of any match, even if you're just starting out. It accelerates growth without extra risk on your part. Another practical angle is to view this investment as a long-term partnership with the market. You aren't trying to time the best moment to buy. You're committing to show up, month after month, for years. If you're worried about a downturn, remember that downturns are a natural part of investing. Your reaction matters more than the downturn itself. Stay the course, avoid big changes, and let time take care of the rest. Your plan should feel durable, not fragile. If your finances change, you can adjust the amount you contribute, not the entire plan. Flexibility helps you stay committed over the long run. Some people wonder if they should also invest in international or small-cap funds. For beginners, it's usually best to master one core idea first. You can add more diversification later as you gain confidence and money to spare. Now, let me walk you through a concrete setup you can implement this week. Open a retirement account or a taxable brokerage account. Pick a reputable, low-cost sp500 index fund or ETF with a long track record. Automate your contributions. Set up a monthly transfer from your checking to your investment account for your chosen amount. If you can, coordinate with your paycheck so the money goes out the same day each month. Choose a reasonable starting amount. If you're early in your career, $100 a month can still work. If you can spare more, $250 or $500 a month accelerates your journey. The key is consistency. Set a yearly rebalance reminder. If you're not automatically rebalancing, you can do it yourself once a year. The goal is to keep the stock portion aligned with your risk tolerance. Track progress in a simple way. A basic spreadsheet or a note app is enough. Record your monthly contributions, the fund you chose, and any changes you want to make. If you ever feel unsure, revisit your why. Why did you start investing in the S&P 500? Reconnecting with your long-term purpose helps you stay on track during storms. Remember that patience matters. The stock market does not move in straight lines. The time your money spends in the market is what matters most, not the momentary dip or spike. Acknowledge the difference between risk and uncertainty. You can manage risk with a steady plan and diversified, low-cost exposure. Uncertainty is a normal part of investing and cannot be eliminated entirely. Your first step is often the hardest, but once you automate and simplify, the path becomes much clearer. Small, steady steps beat big, impulsive moves every time. If you're following along, here are 3 quick checkpoints to use each quarter. Confirm your emergency fund is intact. Review your monthly contributions and adjust if your budget allows. Check that you're still comfortable with your chosen level of risk. In a longer view, you'll notice a familiar pattern. The market climbs slowly, then corrects, then climbs again. Your job is to stay in the game and keep your plan intact through the noise. One practical reminder: avoid trying to outperform the market by picking individual winners. The S&P 500 is a reliable approach because it captures broad market returns. The key to success is consistency, not perfection. It's the daily and monthly actions that compound into real wealth over years. You're building a habit that will outlast the fads and headlines. Before we wrap, imagine your future self thanking you for these small, steady decisions. You created a simple plan, followed it, and let time work for you. That's the core idea behind beginner investing in the S&P 500. If you found this approach useful, think about how you'll apply it this week. Start by checking your emergency fund, then set up that automatic monthly contribution. Keep the plan visible and easy to follow. Let's recap quickly. The S&P 500 gives you broad exposure to the biggest U.S. companies. Start with a solid financial foundation, decide your horizon, and automate your investments. Keep costs low, stay patient, and rebalance when needed. The practical strategy is simple. One core fund, automatic monthly contributions, a clear plan for risk, and a yearly check-in. You don't have to be perfect to win. You just have to be consistent over time. If you want to see more like this, hit the like button and subscribe. I post practical, easy-to-follow investing ideas for beginners and beyond. Have thoughts or questions about your own plan? Share them in the comments and I'll respond. I read every comment and I'm glad to help you refine your approach. Thanks for watching. Remember, investing is a long game, not a sprint. Stay steady, stay curious, and build your future with the S&P 500 in a simple, reliable way. Like, subscribe, and tell me in the comments what you plan to implement this month. Your future self will thank you for the small, consistent steps you take today.